Tracy, good to have you here again. The title of your note is When to Fade the Coronavirus Fear Factor. So tell me what you're looking for in the signs of when to pull the trigger.
Hi, thanks for having me here. I think the biggest sign that should we have is to look for the next vaccine, which is not coming in the near term, but there are a lot of talents around the world are working on it. I think the financial market right now is looking beyond the current ugly data. They're looking for some kind of a hope or silver lining going forward. And people are fear for the fat tail on the left side. Now, I think the right approach is to look for the fat tail on the right side. Because if you look at the massive policy reaction around the globe, it's very hopeful. You have trillions of dollars of like policy action from the central banks and from the government as well. They are sending checks to household, and then small business firms are actually getting loans. And I think it's quite promising at this point.
Tracy, this is one of my favorite conversations to have because we moved so quickly to stem what we thought was going to be a potentially long, dragging, severe event. It still has the possibility of being that. I mean, we look at crude oil and there's some serious problems there, but the market seems to be telling us that potential for the fat tail to the left, the kind of negative, black swan event maybe is not going to happen in the economy. So right now, if we're focusing on the other end, how do you play that, and how do you invest towards a potential either reflationary environment, inflationary environment, or at least one that is just not Armageddon?
I think the best example is to look at China. So what's going on there is very telling because they are the victim of the first wave. So China is slowly coming out of the hole. If you look at the activity data and the GDP data today, it's bad, but actually it's getting better. If you look at the industrial sector, I think the work resumption rate there is almost 90%. What's getting more difficult is the on the demand side. So on the supply side, they were able to resume work to 80 to 90%, but on the demand side, it's still probably 60%. Especially consumers are still very weak because of the massive income shock. And unemployment data in China is also getting slightly higher from 5% to low mid 6%. So for the U.S., I think if we can reopen the economy gradually in May or June, I think that should be a good example to follow China's steps. I think the good trade going forward is to play on the gradual recovery. If it is not V-shaped, it should be at least U-shaped. I think there are a lot of pent-up demand there. The reflation trade in the credit market should be play on the corporate credit because on the high yield side, you have falling angels having some kind of support from the Fed. And on the structured credit side, you have massive dislocation in the RMBS and CMBS side. We all hear horror stories from the mortgage rate liquidation, whereas you see a lot of IG-rated CMBS bond are trading in the range of 20 cents to 50 cents on the dollar because investors, they have a hard time to model the income shock, which tenants is not going to pay the rent. And on the RMBS side, you have massive shock as well, and people are predicting massive delinquent waves, and also from this higher unemployment rate. Some people forecast it should go as high as 15 to 25%, and that's even worse than the GFC level. But our view is that given the policy reaction is both large and timely, especially they have the foreclosure, the forbearance program, which should help borrowers and households to ride through this difficult time. And I think the valuation in the structured credit is pricing a very draconian scenario.
Tracy, we heard a case from a guest earlier this week about how workers who are making less than or equal to $15 per hour might actually be able to net positive with the payouts that they're getting right now in the short term for the next month or two. So if we take some of the policy outlay combined with what we've seen in terms of the strength in parts of this market that are still working. I'm thinking about consumers spending online, the tech companies that have been leading this. If there is then a policy outlay that is enough to be a bridge and to some extent, maybe for some individuals, actually net positive during this period, what's the potential for a shock GDP that is way better than expected? Because I see China at 7% for the first quarter. That was the number that came out today. And that's during the heat of the coronavirus outbreak. But yet Morgan Stanley and others are saying our GDP could be negative 30 to 40 during the second quarter, which is our peak outbreak period. How do we go from China being negative 7% to us being down 20 to 40 when there's still lots of activity happening in certain parts of the consumer market?
Yeah, I think negative 30% is too negative. I don't think that will be the case. But one thing is clear, that the structure of the GDP, the GDP in China and U.S. are quite different. China is more focused on the manufacture and industrial side, whereas U.S. is more servicing driven. So I think this recession is more servicing the service industry recession, because manufacturers, they will rebound pretty quickly and sharply, because after you resume your work, I think it can rebound sharply. But on the services side, you need demand to come back, whereas the demand is very slow to come back because of the income shock to the household.
Tracy, real quick last question. The Fed, with all its bond buying program, stepped into high yield, and then high yield, after a big pop, just went nowhere this week, even as the stock market found strength. What's the deal here? Are investors already moving past that? I thought you don't fight the Fed. Well, how come there's no more buying happening in the past 5 days?
Yeah, so that's a very interesting question. So today and yesterday, high yield credit underperformed the equity market very sharply. So the reason is, I think investors, they are still fearful for the work fundamental going forward on the high yield side, and the forecasted default rate will be higher than 10% for the end of the year. So I think that's a real concern. I think what's really dragging high yield is the oil price. I think people, the OECD and OPEC, so the OPEC can fix the supply if they wanted to cut the production, but the real problem for oil is the demand. We see a sharp downturn in oil demand. But I think if the economy gradually reopen in the U.S. and Europe, I think the demand for oil should gradually go up. I think oil should be closer to bottoming. The problem for oil is the storage. I think the storage is pretty much full at this point. So I think there is room for oil price to go slightly lower, but I think it's closer to the bottoming process.